Hello students, welcome to iExam B. So in continuation of our revision series for RBI Grade B Phase 2 2022, the topic for today's discussion is Global Financial Crisis. So before delving into the topic in detail, I would like to inform you all that the students at iExam B are being mentored by expert and experienced faculty members. I am Shikha Malhotra. I have around 10 years of working experience with State Bank of India and I am FRM certified and CFA level 2 passed. So coming back to the topic of global financial crisis, it started emerging in the year 2007 and the origins for the same were from the US mortgage market or the US housing market, and it is considered as a once in a lifetime event that had far reaching consequences, not only for the policymakers but also in terms of its spillovers to other economies, be it emerging economies or other developed economies. The epicenter of this crisis was the US mortgage market or the US housing market that spread not only throughout the US but also across the globe, and that later changed the dynamics of international financial markets, the interconnectedness of the market, and the overall implementation of international regulations. So, what exactly happened? How this global financial crisis happened? We will understand the whole process and also the terminologies attached with it. The banks in the US were following the basic bank lending model, that is, that they were lending against the deposits. So in the 1970s, the demand for houses started growing. So in order to keep this kind of funding, that is lending against the deposit, this kind of funding was not sufficient to keep pace with the growing demand of houses. So in order to deal with the same, this led to the development of asset-backed securities market. What is this asset-backed securities market? In this asset-backed securities market, the mortgages that were made, the mortgage loans that were made to the borrowers, they were pooled together to form a portfolio, like different type of mortgages, and they were pooled together in a portfolio with a certain amount, and cash flow from this portfolio in terms of interest and principal repayments of these mortgages were repackaged as securities, and they were repackaged as securities and they were sold to investors, right? So why it started growing? What was the reason behind it? First is that there was a dot-com bubble that had happened. So with that, the rate of interest were quite low in US, right? So investment opportunities for investors were quite low because treasury bills and the government securities were giving very low rate of return. So when this asset-backed securities market started growing because of the underlying market, that is the mortgage market, so investment started pouring in. The investment started pouring in this asset-backed securities or mortgage-backed securities, right? And other thing was that US government had created an organization, that is Government National Mortgage Association, in 1968, which is famously abbreviated as Ginnie Mae. So when these asset-backed securities were created, this Ginnie Mae was giving guarantee in return of a certain fee against the default of the repayments coming from these mortgages. So as these default were secured because of the guarantee given by one government organization, the returns to these investors were secured, right? So that's why this is also one of the reasons that this market started growing. It started with mortgage backed securities, then it also expanded towards asset backed securities, wherein apart from mortgages, this pool of investments, were different kind of assets in the form of automobile loans and credit card receivables. Okay. So what is this whole process named as? So as I told, these assets, right, these assets in terms of all these mortgage loans and other type of loans were pooled together and was created in a form of portfolio of certain amount, and out of this portfolio certain securities were repackaged, and then these securities were categorized in the form of different tranches, and this was done through the help of one special purpose vehicle. The special entity was created for this purpose. So this senior tranche, mezzanine tranche and equity tranche, and this particular category of the pool of those securities that were created for investment purposes, that was issued to the investors, was considered the highest rated tranche, and it was actually rated triple A by the various reputed credit rating agencies. So investors were drawn towards making investments in this category of securities because they were highly rated and secured. And this was rated triple B because what was the difference exactly, that this category, how the purpose of the categorization was that whatever the repayments are coming from the pool of investments, first this will come to this senior tranche and then it will go to this tranche. So the probability of default in case of this category of security was quite lesser. But in this category, risk was still higher, right? So this categorization was made and these securities were traded in the secondary market. And this whole process is called securitization. Securitization is considered as a process which was used by the banks to create securities from loans and other income producing assets. As I told, credit receivables also were part at some point of time, and these securities which are repackaged are sold to investors. So what exactly banks do? They remove these loans. They remove these loans from their balance sheets, and this enable them to expand their lending faster than they would otherwise be able to do, right? Because once they offload these assets from their balance sheet and sell it to hedge funds or any kind of investment banks, right, so that they clear their balance sheets off, then they are not required to maintain any capital against these assets, because their capital is also released from that, and then the risk also is passed on to those investors. In any case, the interest and principal repayments will be transferred to these investors, which is coming from the borrowers of these assets, right? So in a way, the banks were getting benefits because of that. They were just selling it, getting money, and then making more lending. So they were making profits out of that. So this whole process was called securitization. And other thing also, which was one of the reasons of start of this whole complex web of events, was the financial deregulation. In 1999, this Glass-Steagall Act 93 was repealed, which actually allowed banks to use deposits to invest in derivatives and hedge funds. Basically, the wall between the banking and the investment banking was broken, and banks were of the view that they want to compete with the foreign firms and want to take exposures in these derivatives and the hedge funds. So with restrictions as per the Glass-Steagall Act, that act was repealed. So because of that also, financial instruments like asset-backed securities and mortgage-backed securities were created, and they were considered the highest form of financial innovations of the 21st century, because everybody was making profits out of that. So when this whole process was going on, the process of securitization, then banks were eager to make more borrowings in order to do more securitization. So they were not only making borrowing from the depositors, but they were making borrowing from the other banks also. So in that, the whole leverage in the whole system started increasing. Not only that, they were borrowing more and then they started lending more also, so that they would create more securitization, so that they could sell off their assets, gain money out of that, and then create more lendings in that process. So then what they started doing, they started increasing their balance sheets and started making more lending to the subprime borrowers. So what were these, who were these subprime borrowers? Earlier, when we were talking about the home loans being made to the borrowers, they were prime borrowers. Prime borrowers in the sense they had enough income at their backing to make the repayments of these mortgage loans, and they had enough credit standing as per the credit score, and they had enough assets at their backing to make good the loss if anything happens like that. They were basically prime borrowers, they were credit worthy borrowers. But in order to increase the lending, they started offering loans to subprime borrowers. Lending standards were relaxed in the whole process. Though the borrowers who were not having backing of substantial income to make repayments for these loans were granted loans. They were basically called the ninja borrowers. No income, no job, no assets, right? So in, and even they were like told also by certain investment bankers who were making profits in this whole process, how to increase their credit score, that FICO score that they have, no, how to increase their credit score. So only out of that credit score they were given the loans. No application, substantial application form, no substantial asset backup, nothing was there. Only the house that they were purchasing was taken as a mortgage, as a collateral. That was the only backing, because the housing market was growing, housing prices were growing, and these borrowers also thought that even very low rate of interests were being offered to them, and even obviously loans were being, which was not offered earlier because they were not eligible. Only that time when loans were granted to them, then they took the plunge and they started buying houses, right? So interest only and adjustable loans, what are these interest only and adjustable loans? These are the kind of teaser rates in the beginning of the repayment. Teaser rates were as low as 2% at one point of time. So these borrowers were lured to make purchases of the houses and take loans because the rate of interest initially were lower. And then after a certain period of repayment time, like 3-4 years or 3-4 years or 2-3 years, these teaser rates were converted into adjustable rate of loans, which was actually linked to the Fed rate. Right. So initially, these borrowers thought that rates of interest are very low, they are very much affordable, and as per their standing, whatever they had, the loans were being granted. So this way, the whole exposure system and the balance sheet expansion was being made. And this collateralized debt obligation is an investment product that represents different loans bundled together and sold by the lender in the market, that we have discussed. These were CDOs, right? So in order to expand further, this whole process was going on, creating tranches, selling to different kind of investors, because interest was little higher in this investments, because they were having little risk attached with them. So as the market was growing, underlying assets were growing, investors were thinking it's okay even if it is triple B rated, in any case this market is growing forever, right? So what then these market players started doing, they started creating tranches out of tranches. Then further categorization of this tranche also they started doing, and out of triple B rated tranche they started creating triple A rated, then again triple B, similar, that senior tranche, mezzanine tranche, and equity tranche they started creating. So you can see that complex and intricate web of the whole financial instruments that was being done was actually the responsible, the was mainly responsible for the origin of this whole crisis. And the way credit rating was done was not even known to the credit rating agencies at that time, because they were actually, as per the existing debt obligations, they were giving credit. But this whole process, only this creation of whole debt instrument was different from the normal debt instruments, so that they did not realize. And other thing which was also major part of this crisis was the issuance of credit default swaps. The investors who were making investments in these securities, they were buying insurance type of guarantee from the credit default swap seller, which is AIG, right? This was the highest rated insurance company in USA at that time. It started dealing in credit default swaps against these asset backed securities. It was issuing guarantees in return of a fee in terms of quarterly premium. So these investors were credit default swap buyer. They were buying some insurance from this AIG, that is credit default sweller. So in case any unexpected market event happens, if the underlying assets, that are the mortgage loans, if any default happens in those mortgage loans by the borrowers, and these investors do not get their money, right, then in times of do not get their return, so in terms of that contingency period, this credit default swap seller, that is AIG, will make good the loss. So that was the process. AIG had taken lot of exposure during that time in terms of selling this credit default swap, because as I had told you that this process of securitization, creation of securities, selling to the investors, making loans to subprime borrowers, this process was going on. Everybody believed that this will go on forever. Housing market will be in the boom period forever, and there is no lacuna in this whole process. So that's why AIG, in order to earn more profits, it started taking exposure in CDS markets. It started selling CDS to the investors, that is credit default swap buyers. Then what happened? Then what happened is, first of all, the mortgage loans that were being given to those subprime borrowers were mainly non-recourse in many states of US. Non-recourse, that bank can go and chase only the collateral attached with it, but other assets of the borrower will be off the limits. So bank did not have any kind of recourse available against the defaults that happened. Why default started happening? Because the banks had that adjustable rate loan system was there, which was attached to Fed rates. Right. So whenever the Fed rates will change, these rates will also change, as happen in our country. Like when repo rates change, the ultimate objective is that lending rates by the banks will also change. Similarly, these adjustable rate loans came into operation after 2-3 years of teaser rates application. So in the year 2004, Federal Reserve started increasing rates. So then the borrowers started getting the heat, that the obligation in terms of payment of repayment obligation in terms of interest and principal started increasing. They did not have any means, right, to make these investments, because as I told that they were kind of ninja customers. They did not have much income backup at their hand. So then what started happening? They started making defaults started happening, foreclosures started happening, and the number of houses were available for sale in the market, because banks had only recourse towards the collateral attached with that loan. So many defaults happened, and so many houses were available for sale in the market. When the supply started increasing, then prices started crashing. So the real estate prices started crashing, by end of 2007 and early 2008. So US was not only alone in having declining real estate prices. Real estate prices in the UK were also badly affected because the investors in the UK had taken lot of exposures in the US mortgage market, and moreover even the this interconnectedness of the markets also affected the real estate markets. So all these investment banks, Lehman Brothers, they had taken enough exposure in this securitization and this mortgage-based securities market. So when the collapse started happening, when the repayments stopped coming, returns stopped going to those investors, the value of those securities started crashing. The claims came on AIG of those CDS defaults. When the defaults happened, the claims came on AIG. Then every whole system started crashing together. It created a kind of ripple effect, right? One thing led to another. Housing market plummeted, sorry, and then after that what happened? Housing market plummeted, and then those asset backed securities market got affected. CDS market got affected because AIG had taken a lot of exposure, and other investors all across the globe who had taken exposures in such type of markets also started getting the heat, right? So then all these investment banks, they started collapsing, and the Lehman Brothers, which was the largest investment bank at that time and very oldest bank of US, which had also survived the Great Depression of 29 and 30 also, it collapsed and it was allowed to fail. AIG was bailed out by the government. Bear Stearns, another investment bank, was taken over by JP Morgan Chase. Merrill Lynch was taken over by Bank of America. Right? So the whole system collapsed like this. And then what is the impact on Indian economy? What was the impact on Indian economy? As Indian economy has been an emerging and a growing economy, so that time also many foreign institutional investors had made investments in Indian stock markets and taken positions in consumer goods stock and infrastructure based stocks because it was growing at that time. So when this whole situation happened, they started offloading their stakes because they wanted cash in return in order to meet liabilities of their parents' companies back. So the outflows of foreign flows started happening to a great deal. I mean, considerable amount of foreign flows started happening, which had an impact on Indian economy in a way for a brief period of time initially, yes, and it had a impact on exchange rate also, because when these foreign investors offloaded their positions in the Indian stock market, they got rupee in return, but they wanted dollar in order to send them to the respective countries, because in order to send to the respective parent companies, right? So the demand for dollars started rising. Even importers and exporters also started demanding the dollars. But Indian banks did not want to part with their dollars because they want to keep the dollars intact in order to meet their foreign exchange transactions. So RBI started intervening. So even during that time when the stock market also crashed, and the January 2008, that our stock market was, Sensex was 21,000, and by November 2008 it plummeted to 10,000 or something. And similarly exchange rate also, which was around 39.4 by 2007 and or 2008, it actually it was 50.6. It depreciated against the, started depreciating against the dollar. So RBI had to intervene. With that intervention, the credit availability was affected in the domestic market. So then all these happened. So there was initial slowdown. So in the financial year 2009, this rate of growth was 6.8% because it had already been 9% in the last consecutive 3 years. It went down to 6.8%. So government took various measures in order to increase the aggregate demand and bring the economy to pre-crisis level. So by the year 2011 or something, I think rate of growth was restored to the pre-crisis level, and even the dollar rupee also improved against dollar. So India as a whole was not impacted to that extent as compared to other developed countries, like mainly the European countries, because they had taken exposures, one. And second is the sound macroprudential regulations of Indian economy, and the stringent regulations in the banking sector by the central bank also made it survive the big jolt of global financial crisis to a great deal, right? So with that, lot of international regulations, particularly the Basel III norms, which actually are a response of global financial crisis, came into being, and various countries adopted these measures wholeheartedly, because after seeing the repercussions of global financial crisis, everybody took a stance which was a kind of safeguard stance. So in that, various measures were introduced which were new. That first was liquidity ratios were introduced, because that time it was felt that at the time of global financial crisis, banks had capital at their place, right, but did not have liquidity to meet the needs in their stressful period. So this liquidity risk was particularly identified, right? So two liquidity ratios, liquidity coverage ratio and net stable funding ratio, was introduced in Basel III norms in order to contain the liquidity risk. And the second is your leverage ratio. Leverage ratio also was introduced so as to maintain capital against the exposures, so as to restrict the leverage to certain extent, which is stipulated minimum 3% needs to be maintained. And the other is your buffers, capital conservation buffer, which needs to be maintained, which additional capital needs to be maintained during the normal times, which can be made available during the stressful period. And when the stressful period happens, after that period, replenishment of the same buffer would be starting again. So capital conservation buffer was also 2.5% of risk weighted asset that was proposed in Basel III norms. And similarly, counter-cyclical buffer also was introduced. Right. Similarly, all these measures in terms of international regulations and coordination of policies in order to contain the spillover effects were the topic of discussion, and have been topic of the discussion even after so many years of the global financial crisis. Whenever we talk about any international financial regulations or international financial dynamics, we always start with the global financial crisis, because that was the impact of that crisis that changed the dynamics of everything altogether, right? So that was about the global financial crisis and its impact. So we at iExamB makes your exam preparation 50% faster, because we provide you with various facilities in terms of crisp notes, quizzes, current affairs, and lot of other avenues for your preparation to make it 50% faster. And regarding the schedule of the classes for RBI Grade B, the regular classes every day are going on for Finance and Management, ESI, and Descriptive English, wherein the mock tests are being thoroughly analyzed and discussed, and how to write the descriptive questions, and also discussions about the objective questions are being taken place. So out of these 25 tests, 15 mock tests are being discussed, wherein you will get a proper understanding of how to structure your answers, which will help you a great deal in an actual exam. So please avail of the opportunity. And yes, we prepare you 50% faster at iExamB. So don't forget to subscribe the iExamB channel, and don't forget to press the bell icon.